Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, September 15th, 2022. It's 9:46 a.m. As I'm starting the video, so only about 15 minutes into the trading day, and I just want to get one out. I've been going over the charts this morning. I just want to say I didn't fire off any charts because there was absolutely no updates. I did, one right before the close yesterday. And I got that 5-minute chart out to you as well as this one here. And there's really no change here. I'll get to that 5-minute chart in a second. Like I said, I usually don't make those macro calls, but at this point in time, you might see more and more of those because when we're sitting, remember, it's the charts are what I call stacks. So sometimes you can get clues if you see that 5-minute chart breakdown with the take out the recent lows, which that I'll get to it in a second. But that's what we were looking at yesterday on the 5-minute chart. And but bigger picture is, of course, if we take out those lows there, then you've also taken out this much more significant uptrend line on the 60-minute chart. So that's what we're watching, and QQQ continues to struggle with that trend line. When I say struggle, I can't overemphasize this or state this too often. Support is support unless broken. So you got to break the support. You've got price support a hair below at 12094, give or take, but the trend line there, and so I think it'll go. And when I say hugging the trend line, in a healthy trend, you come back, you visit a trend line, and you bounce. This one's not as super well defined or as well defined as the S&P 500, which I'll get to in a second. That one's really well defined, but in a healthy uptrend, again, you touch it and then that's it, and you're off to the races. Here, let me show you ES. We'll just start there so you know what I'm talking about. ES, bear with me, I've got it here somewhere. Let me zoom out to my 3-month hourly. And so there it is. That's the same trend line, very well defined, lots of reactions on it. At this point, you probably tweak it down to where I have it, where the blue line is, and you can see there lots of reactions. You got 2 distinct reactions early on, one there, and you hit it, and you rally off. You hit it again. That was the last test of it. Explosive rally, right? But then boom, right back down to it. And so this is usually signs of waning momentum. And of course, you're in a downtrend, simply defined as lower highs and lower lows so far. But that downtrend will be confirmed or further validated if we take out the trend line breakdown and then take out those lows. Is there any guarantee that it's going to be the waterfall selling like I'm talking about? That's like I said, there's just that I think there's a good possibility, a good chance that we can get that if these levels break, but we'll watch it. We break that, there's always a chance that the market has a little whipsaw. You're going to have, if it's a marginal breakdown, the selling I suspect will be impulsive. I think there's a lot of stops sitting right there. A lot of longs that'll get shaken out, shorts that'll pile in, and then do they, turn around and ramp it and have a false break? Anything's possible. If that happens, we'll address it at the time. First of all, if we do rally back to it, a back test would be an objective short entry if you miss it. Again, but first things first, we don't have the breakdown. So just as I said yesterday, you can make certainly make a case to go long here. It's not the case I'm doing, or not the trade I'm making, but you can go long here at support with a stop somewhat below. That's trading 101. By pullbacks to support, or you wait for a break of support. So again, I didn't get these out because it's the same thing I was saying yesterday. And then that 5-minute chart, I had to send up. I'm having issues with my 5-minute charts. And I sent a request up to Interactive Brokers today on this. Actually, now it's gone. It's cleared up. It was in pre-market. Maybe it's a pre-market thing. It was getting this false shadow down below the candle that was distorting the picture, and like this. That's what I had sent off to them. So hopefully they fix that. It seemed to have fixed itself now that we're on the regular trading session, but that little for the last few days I've had that shadow there, and it makes it hard when you're trading off these 5-minute charts because then you're not looking at the actual where the candle really is. But fortunately I run other charts on other monitors, and I have streaming down to 1-minute charts, so I'm watching it and I'll pick up those irregularities. But all right, where I'm going with that. So there was that micro call yesterday. Where were we? Were we right here? Yeah, we had bounced back. and I suspected we go down, but then said, we need to take out that level. And what they did is they ran down for another test of the lows right there, and they never took out the lows. In fact, that was ever so slightly. If you zoom in real tight, it was ever so slightly above that those two previous lows on NQ right there at about 12.079, but it coincided exactly with the break even on the Qs, and then the buying that last minute in the end of the trading session, they turned on the algos, the buying programs, and somebody, whether it's a PPT or somebody, wanted the markets green, because if they went one tick lower and closed there and taken that out, we would have closed, had another red day. Either way, it was a marginal, it was barely a green day on the Nasdaq 100, and I'll get to those charts in a second. But that's it. Look, we're just bouncing around right above. Remember, this is that trend line test. So on the near-term charts, if we take out that 12.079, that's also going to be a break of the trend line there. And like I said, you want to watch those. The 12, yeah, about 12.094, yeah, and that's the same number really. So, and again, you want to see it impulsive, solid. Like I say, the redder the better for a breakdown. And until then, like I said, they're going to step in and buy support, because that's what traders do. They buy pullbacks to support, and if they can successfully defend it, then maybe we get more of a rally. I don't think so, but I'll certainly adjust and let you know if and when. But for now, I'm sticking tight with the swing shorts. I think that level will go, and when it does, that's the next objective add-on if you're already short, or new short entry if you don't have any shorts for the Nasdaq. Okay, and if you're watching QQQ or trading that, there's your same trend line there. And that's simple stuff, right? So like I say, the more reactions you have on a trend line, the more valid it becomes, the more eyes see it, and therefore it's more technically significant. Just below the trend line, you have a support around, that's that previous reaction low, give or take around 1291, 1290, something, 1292, somewhere in there. And then on SPY, remember, you want to see both SPY and QQQ break down. Both major indexes, and then you can see again it's just been a beautiful uptrend line on SPY, and so you want to call it bulls are in control, you want to say bears are in control. Like I said, that the near-term trend right now is bearish, but we haven't yet to make a marginal new low. You take that out, and again, that's where because of that, you're going to have a new low, you're going to have a significant trend line break, and I think it'll be a quick swoon down. These are some potential speed bumps along the way, and we'll see. I suspect, and I'm surprised really that we're not seeing follow through right now with less than a week to go to the big FOMC meeting. It's baked in the cake. Here's the thing. It's pretty much baked in the cake, 3/4 point rate hike right now. And the market's going to be waiting to see what the Fed says. The market continues to try to predict and anticipate, and that's the reason cited for these bear market rallies, that the Fed is going to back off. Not just a few weeks back there was talk that when they were going to start cutting rates again. I mean, it's ridiculous, but that was cited as a big part of this rally. And as I said, the narrative would change, and it did, and the narrative's going to keep changing. And this is just bear market action. These are hopium rallies. Hope that the Fed's going to back off. Hopefully the Fed's going to engineer a soft landing. Let me show you one other chart I haven't showed you in a while. You know me, I trade the small caps at times, sometimes the mid caps, so quite often the large caps, and I'll use NQ as my primary trading vehicle. But if there was just one index that's the most representative of the stock market, the stock market is a combination of thousands of companies, thousands of stocks, and the S&P 500 does a great job, but that's only your largest companies, the 500 largest ones in the U.S. You're missing the universe of the small 2,000 stocks in the Russell 2000 index alone, 2,000 small cap companies, and there's a lot more than that aren't in the index. And then you have mid caps, huge amount there. But this one, the Wilshire 5000, is a total market cap index. It covers the whole spectrum. It's 5,000 and small, medium, and large. So it's really the stock market if you want to look at it that way. And again, the chart is just as clear as day to me. It doesn't guarantee it's going to play out the way I think it does, but or think it will. But there's, back then it was 2015. You had a divergent high, and this was a year-long correction. You can see from 2015 we peaked a little after that, went down. That was depending on what index you're looking at, close to a 20% drop. And again, if you really look at where you finish there, you go back and you can see the pop-up box. That was 2.5 years. So the person that bought here back in went long the market on the end of July in 2013 found themselves exactly where they started in the beginning of 2016. So I refer to that as a deer market. A deer market's a term not used often. It's a market that's neither a bull or a bear. It's just a sideways market. And again, but where am I going with that is it was clearly identified in advance, and we were short on it with the uptrend line, the negative divergence, the break of the 200-day, aka 40-week moving averages. You can see the red and yellow line. They broke right there, right after the trend line did. And then just like now, let me get back to that. I've covered this many times recently, but let me just zoom in to that period. See your 200 days acting as support, and then once they were clearly taken out, solid sell signal with that red candle, just like now you had an opportunity to short the back test. When you're in a bearish trend, when you're well below, when you've walked away and taken those out clearly, not just 1 week right there, but clearly below and for several weeks or months, you short the rallies back to it. And then finally, you could have shorted there too if you thought it was going lower. I can't remember where I was at the time. But once you see they've been regained, that's it. Then there's support. And it's easy peasy. You just buy pullbacks to, use that as a trend indicator. And you can see here, there was our breakdown there. And boom, it was your kick back to the 200-day slash 40-week simple moving average, number 1 right there. Perfect little back test, and then number 2 right there more recently, perfect back test. So all right, where am I going? Again, this is a good proxy of the market. So here's what you're looking at now. You've got a downtrend line now with that third reaction recently that was also off the 200-day moving averages. So you have a confluence of resistance. So now you have a validated trend line with at least 3 distinct reactions, 1, 2, 3. You've had multiple rejections at the 200s. And so what starts to change my longer term outlook would be a solid break and solid weekly close. All the better 2 weekly candles. Get away from those 200 days, put them clearly in the rearview mirror, because it's not unusual to see a 1 week close above, a little whipsaw, maybe even 2 weeks. But the more you go up, and then you've got nice horizontal price resistance as well. So if and when that happens, maybe this marked a significant bottom, but we'll see. That hasn't happened yet. So what I'm watching for, and this is anytime, I'll start to talk about that if we get there. I'll be talking about that as an objective shorting entry at first, and then also as a objective area to go long if things start to firm up, fundamentally as well as technically. But right now we're a lot closer to this uptrend line off the lows, so there's no reason really focusing or talking about the trend lines or the 200 days because we're well below them. So we're watching just like we are on those short-term charts of QQQ and SPY and ES. We're watching these uptrend lines off the lows because we're right on those right now. So in other words, if anything's going to happen this week, it's going to be a break of these, not a breakout of the. So there's nothing this market can do, in my opinion, this week. Would have to rally, from where we're at now. We're at the bottom of that candle. You'd have to rally over 10% to have any technical change to the outlook of the indexes, because you'd have to go well over 10% to take out that trend line in the 200 days. So that's it. So until then, this is what the markets do. They go back forth, especially in front of an FOMC meeting. As I mentioned the other day, there was a lot of economic reports this morning, and the market's going to try to decipher those whichever way it does, and that's that. So like I said, let's not over complicate this. This is pretty simple stuff, just like on the NASDAQ 100 on SPY. We're right at very close to trendline support. There's a little opening there. So far they stepped in and bought that support once again. Here we go, QQQ. They're rallying on off the open because they're buying support. Like I said, support is support until unless broken. So All right, I can't make it any more clear than that. So, like I said 2 days ago, and I said today again today, until unless we clearly take out the recent lows, there's no reason to be adding to any short positions or taking any new short positions right now, unless you get a decent bounce back to resistance. That's one thing I didn't mention there. Um, right now, we're at resistance. Really, if you zoom down short term, you can see this is a 5-minute chart. You could, it's more aggressive, but you could certainly take a shot here on a bounce back to this 296.77-ish level, because that's the recent trading range. If they pop that, then they're probably going to run up to the next resistance level. But the MO when you get a trading range is you short and then cover the bottom of the range, and you go long and you sell the top of the range, reverse to short, back and forth, back and forth. And then whichever way we break, now, with the Fed coming up next week, the big FOMC meeting, the odds of whatever way this thing breaks being a whipsaw is pretty good. But again, based on everything I just showed you on the long-term charts, including the Wilshire 5000, this is what I favor. And so even a pop right now today over those highs wouldn't shake me out of my swing short positions. I'm just waiting at this point to add on there. And this market, I severely doubt this market's going to run away in front of the Fed. If anything, I'm betting on some selling, nervous longs getting out of there, shorts maybe piling in. And if nothing else, I talked about this back in 2018 before it happened and while it was happening, that the market would throw a hissy fit. That was the last time the Fed they pivoted from and started to raise rates back then, and the market, just like a spoiled child, threw a fit as predicted. That was that huge drop in the fourth quarter of 2018, and as I predicted, the Fed right on cue turned around, pulled a 180, and gave that spoiled, whiny, child, the little brat, they gave him what they wanted, the cookie or whatever the kid's crying for, and that means they turned around and they stopped. They went from hawkish back to dovish, and then so they gave the market the juice. And then COVID took it away there, and they gave it even more juice. And now they're taking the juice away, and there's no sign to the end of when that's going to happen. If the Fed sticks to their plan, it's no time soon. But again, the Fed, it's not that they lie; they just don't know what the hell they're doing. That's the problem with the Fed, is they're completely reactive. What's going to happen? My guess is we're going to go down. Soon we'll hit these deeper targets. That's another 20% drop in the Nasdaq 100. And then they're going to talk about balancing the risks of inflation with economic stability. They won't talk about it, but I'm sure they're just as worried as a lot of folks are that are really into the financial markets. The huge liabilities with pension funds and just the impact it's going to have on consumer spending and sentiment. So, well, that's that. Retail sales reported today. Those numbers came out. Here's XRT. This is a kind of a gauge, if you will, for consumer spending. It has all your big retailers: Amazon, Walmart, Costco, Target, TJ Maxx, Dollar General. All those are some of the top holdings there. And to me, this one is clearly in a downtrend. You can see this is a weekly chart put in. It wasn't a random drop so far. It was a biggest divergent high on the weekly chart since back here, much bigger than that one. And that drop there, if you measure from that divergent high, I got to grab over here just to measure the same price point right on that line. Before all said and done, the retail sector fell 51%. You can say it was because of COVID, but no, it was already in a downtrend, and it just continued, and it just accelerated the end of that drop or that bear market. So far we're down off an even larger divergent high, and for the first time in decades, with runaway inflation, and they're down 40. They were down at the lows about 45%, but based on everything, I think they'll be, before all said and done, there's more downside to come in that sector. But just remember, nothing goes down straight down. Even in bear markets, there's going to be bear market rallies along the way, and that's what we try to do here with swing and trend trading. Oh, sorry about that. I thought I had on pause. I was, let's move on to the next one. I was thinking what to do next. I'll go to UNG. There were quite a few questions under that post yesterday. There was that 31. And somebody asked a good question. They said, Randy, when you say stop somewhat above, and you can check that, go under the post. I replied to that comment. Somewhat is absolutely relative to the security you're trading. So in that reply, I said, for example, if you're trading treasury bonds, if I'm using a stop somewhat above a resistance level, which first of all, if I'm short a security, then usually my stops are going to be strategically placed, not just randomly, strategically above a resistance level that I believe will cap any counter trend rallies. So let's say I'm trading treasury bonds. I may use a stop of, 2, 3. It depends on the time frame. If it's a long-term trade on the daily charts, could be several percentage points. But if it's shorter term, 60-minute charts, intraday charts, it could be 1% or less because treasury bonds rarely move up or down 1% in a day. Natural gas, on the other hand, regularly goes up and down double digits in a single day, 10% or more. I've seen it up 15, I've seen it up 20%. And then it can do it again the next day and the day after that. Right now it's down 7%. So relative somewhat is, that, I would say roughly 4 to 8% would be the number. So 31, and it went up about not even 3%, 2.75% above that. Filled the top of that gap yesterday, and then a reversal. Oh, and then the other question was a good question. That's why I'm revisiting this. Is I said, Randy, I don't see any divergences on natural gas now. Why would you expect a reversal? Well, that's a great question. Remember, just like I use the weekly charts to kind of hone in on my bias, to give me a bias on the shorter term charts, on the 60-minute and the daily charts, I look at the big picture and then, okay, what's the big picture? Bearish? Are we in a bearish trend, bear market, or are we in a bull market? Then I'm going to decide, for example, like QQQ or NQ, when it pulls back to the support level, do I want to step in and buy and be, in my long-term and trend and swing accounts, I want to buy that support level, or do I want to sit back and wait to short a break of it? Okay, so that, and the same thing here. So my answer was, yeah, correct. No divergences, at least not on the 60-minute time frame. But you're coming off a big divergent high here. Well, this is just a 60-minute. That's a big bearish rising wedge. It was a textbook bearish rising wedge pattern, textbook impulsive breakdown. So you don't want to see a little limp through. You want to see a big red candle. Redder the better. You hit support. You danced on that support for a while. Then you broke down below it, had the next leg down, and then, like I mentioned the other day, we hit the first support level. And this is only the first counter trend bounce in natural gas. And again, if you trade natural gas, you know this, and then someone in that the comment section had cold. Okay, natural gas in itself is about the most volatile commodity that I ever trade that I can think of. Fewer things out there, other than maybe cryptocurrencies, Bitcoin and Ethereum, are more volatile than natural gas. It's just the nature of this beast, again, for the reasons I said. 20, 30, 40% rallies and corrections in just a matter of days or weeks are the norm on this thing. So therefore, you take this and you juice it up with 200% leverage, you have to use beta adjusted position size. I write about that. Go into the FAQ section of the site. It's under resources on the top menu. I explain that. There's even a calculator I created to calculate how to beta adjust your position size. So if you're trading natural gas, number one, even non-leveraged UNG is you have to severely adjust your position size. What does that mean? That means if you take, let's say your number is 10,000, you put into QQQ or Apple, you want to put maybe 3,000 into natural gas. Why? Because if you're right on these trend trades, you're making 30, 40, 50%, you don't need a lot of money to make a lot of profit because the percentage gain's so high. But on the flip side, you're going to get stopped out, or you're going to give yourself an ulcer if you're not willing to ride out counter trend rallies that are going to be measured well into the double digits. So again, so the answer to that question about why no divergences, well, guess what? We had divergent one, two, three, four. This is a huge divergent high, and this is on itself. If you even want to exclude that one, you have divergence right here on this wedge. That's the same right here as that 60-minute wedge I showed you, but this is on the daily chart. So this is a powerful divergent high, a very clean bearish rising wedge pattern. You'll see the same thing on nat gas futures. Then you had this has pretty much been the highs. We had over that level, failed breakout. Nat gas or UNG failed to hold that level, and the bottom fell out once the bulls realized it couldn't hold that breakout to new highs. Then it tested that level again, got rejected. Finally, a breakout, and that has so far proved to be another bear trap, or bull trap, I'm sorry. Sucked in some longs, but then we went below it. So we came back, we rallied back to price resistance around 31, and so far got rejected. And again, and what I said in that reply was, this was only the initial leg down. We just had the breakdown. We had one leg down. Sometimes, and I thought we might get this kind of where natural gas breaks and just keeps going, but sometimes you get a breakdown and a little kickback rally, and then the big drop comes. And everything goes in waves. These are all levels where you're likely to get reactions. So anyways, that's my thoughts. Still think we're going lower, but that's it. And so me personally, I have three tranches on NG, three layered stops. They're all not far. They almost clipped me. I woke up this morning wondering if I would be out. And nope, they're set. I don't know, what is it? I'm looking over another screen. 916, 9160, 9211, and 9254. And so that's how I do it. So if they pop me, I get a third out, a third, and another third, roughly. And I'll still leave those in. But what I'll do now, since we already had the counter trend rally and a rejection, so I have three layered stops. They're relatively tight, and just a little bit above each other up here. Boom, boom, boom. What I'll do at some point today is I'm going to take this top one and lower that down, because we should not run at those levels again. And then I'll take the next one down, and that one will be moved down, and so forth and so on. But hopefully we see that now. But again, who knows? And again, this is one of many trades. Everything is asset allocation, diversification. Don't put all your eggs in one basket. Whatever amount you're comfortable with. NG is very volatile. I call it the widowmaker. It's going to make you or break you. Maybe that's the piece of the pie of your overall portfolio, and you have some index shorts and some gold and silver, which we'll get to right now. Gold, let's go to, let's look at this 6 month, 2 hour, and gold is punching through. Remember, in the last week or so, I've said I'm very open to a little false breakdown, a little punch below the recent lows. I'm going to get to GLD in a second. So far, that's what's happened, and like I said, I'm sticking tight. I still like gold and silver very much. Still holding those swing trend positions. There's that downtrend line in gold right there. These are the same chart I got out to you last week. I might have referred to these as 60-minute charts when I got them out a few days ago. We were at resistance in gold and silver on the futures, but they're 120-minute charts. I should have clarified that afterwards. But so when you look at GLD, remember we were at and still are right at the bottom of my long-term buy zone right here. I know this chart is busy, but this area here has been my buy zone for years, the last 2 years now, and we hit it. It got in it there, hit the bottom, and just the other day I said I'm very open to the possibility we're going to come through here, because it's such a well-watched level, and this is just the nature of the beast these days. These big trading desks, these firms, they use these algo programs. It's also market makers. I don't know gold if the market makers can pull it down, but you almost have to count on false breakdowns. They like to shake out, clear out the weak-handed longs, clear out all the stops, suck in some shorts, and then reverse it. Now, it could be the real deal, and we could keep going, so don't get married to it. But like I said before, that's it. We have a slight pop below, but like I said, I'm giving it some room because we have very strong divergences. And so at this point, if I had no positions at all, I wouldn't add. You don't add on a breakdown. That's again, that's contrary to trading. If anything, you short a breakdown and then you cover it if it fails. But if I was looking to go long and I didn't have a position, wait for the recovery, because at that point, once you move back solidly back above 158, you then have the bear trap, because you broke down. Short sellers will step in. The weekend and longs got stopped out, but then once you recover, that's where the short sellers start to get squeezed out, and that's where they call it a bear trap. So it hasn't happened yet. It's just what I'm thinking will most likely happen. And what would be the catalyst for that? The Fed. I think next Wednesday is a good chance. When they come out, they're going to give us 3/4 point hike, but they're going to hum and haw and start to slowly backpedal. I think Powell, he felt a little proud. He was talking tough, at Jackson Hole a couple weeks ago, and I'll bet you anything, especially if the market goes down any further between now and next week, he'll then be worried about, the Fed's one of they have two mandates, maximum employment and price stability. Well, price stability, what is, define that? If the stock market craters, economic confidence or consumer confidence goes down, consumer spending, everything goes down with the stock market. And the housing market, we're already seeing that turn. So, he'll have to at some point balance the risks of inflation. And of course, the economy itself going down hard enough is going to take care of inflation. So, anyway, we'll see. That's just me kind of guessing what may happen, but sooner than later, he'll start to cow down again. It's in his nature to be easy, and if the street even gets a whiff of that, then you should see the dollar continue lower and the euro continue higher. Which, remember, we have this big bullish falling wedge pattern in the euro. Let's load these. There we go. And so that's what I'm watching for. Remember, we hit it the other day, and that's when gold and silver pulled back. Like I said, we ran up and we tested. We were at downtrend line resistance there on the euro US dollar pair. And so this is a bullish falling wedge with big positive divergences. And whether what the Fed does on or says on Wednesday is a catalyst or not, well, watch this. This wedge could form a little longer. It may never break out. Like I like to say, just like support is support until unless broken, resistance is resistance until and unless broken. If it is broken, resistance once broken then becomes support. So you get a breakout, run up here, hit that 102.854, maybe not back test, and so then that would be an objective long entry or re-entry. And then ultimately, I think we'd work our way up here, and that would be a very powerful move in the euro, big drop in the dollar, and it would be, if it plays out, it would be very bullish for gold and silver. If it doesn't play out, then guess what? Gold and silver probably not going to do well. So, like everything else, don't get married to them. Don't overweight your portfolio. I'm just waiting to stack on, start adding to those positions if I get this additional evidence. At this point in time, I have no desire to add to them on weakness. Especially with gold breaking down, like I just said, you got to wait at least for that bear trap to materialize. And that's the other one, and then I'll wrap it up. Same kind of things I'll focus on lately. There's USO, crude oil, and still kind of like I said, it's. I'm giving it some room. Told you it had some, this is a support zone right here on USO, 71 to 69.50. In the divergence, which gives me some concern. But remember, we're coming off this this is bigger picture, very big, massive divergent high, and it's in a downtrend right now. And in bear markets, including the stock market, it's like a bull market in reverse. You're going to get divergent lows, and they're going to look tempting, and they are going to suck in buyers. They always do. But then in a bear market, these divergent lows either don't play out at all. You get the divergence and you just keep going and it burns through, or you start to rally. It looks like the real deal, like it does in a bull market. But then right as it gets going, they sell into it, and that's a signature of a bear market. So we'll see. It's too early to call, but I will say this. They've recovered this level. Crude popped above it, but there were no follow-through buyers. That right there should have been a bear trap. They took out support. That's where I added as a short most recently, or the most recent add-on. They recovered it, but guess what? No follow-through. Usually once you get that recovery, you get some pretty impulsive buying. So it's still anybody's game right now. You want to play it safe if you don't have a position. Wait until the recent lows get taken out. Let me show you CL, and that's here's what it looks like. This is my 10-minute chart. I'm just all over the place with these different time frames, but there's, we've been diverging. This is one reason I've given it some room, just like nat gas. You had divergent high there, you've been moved lower, and then today, boom, we had a nice breakdown of this uptrend line, and it looks like the next stop here is 85.18. And if that goes here, let me go back to my longer term chart. Let's go to a daily 1 year. Okay, so this is it. Like I said, this gives me plenty of reason to be concerned. We have that divergence there, divergence. But if it's a bear market, if this was a major top in crude, and crude's been stair-stepping lower since, certainly in a near-term downtrend, there was a breakdown right there that I mentioned the other day, and the little whipsaw recovery, but like I said, given a little room, that's so far there's no follow-through buyers. Usually they smoke these bear traps, especially a break below a well-defined support level, really traps those short sellers in, and they keep getting roasted. And so far that's not it. So at this point, look, boom, that's where stop should be over that recent high, because they just may want to come back and backtest 85 and then go up. But if they fall down here, then this was the bull trap. So you have bear trap, bull trap. I don't know. That's how I see it. So I'm still maintaining this target right now, about 73.76. That would be a 17% drop. It would help for the stock market shorts, the NQ and RTY or whatever you're short, to see crude hold up into the Fed meeting. Because if we saw a big drop in crude and natural gas before then, the Fed might see that, see a little abatement in inflationary forces. But the longer or the more crude and natural gas hold up, the worse it is for the stock market, because that means the Fed has no choice but to stay tough and continue to talk tough. But we'll see. I always, like I say, I trade every chart on their own technicals. I mention all these things that may or may not happen that should have an impact, but sometimes, and they do, usually all these things that I'm talking about, but sometimes the impact is not immediate. All right, if that makes any sense. But anyways, we'll wrap it up here. Nothing's changed. Bearish equity markets, waiting for a break of the recent lows for the next sell signals. Still bearish and short natural gas, crude oil, and still bullish and long gold and silver. And that's the only other chart I didn't cover with you. That was silver the other day. We were right here at the dual resistance, the downtrend line. And like I said, silver favoring, I usually do over gold, tends to move up more. So if silver can pop this trend line, really this is the BOD level, 1994.3 on silver futures. If it can pop that, should be a straight shot up right there to that next target, about 2071 and then 2254. Otherwise, if you can't get over there, then you have I'm going to put you one line, give you one line right here, put a line right at trying to find, yeah, there it is. I would say that's a pretty good level right there. If you want a relatively tight stop, well, you could use that first level a little bit below that. That's 18.95.20 and then 18.436. But again, we'll watch that euro, US dollar, and as of now, like I said, I favor an upside break there in silver. All right, that's it. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.